We are living in some desperate times where we vaguely make some young fake scammers the influencers of our society. Forbes 30 under 30 list is one such belt of golden scammers that are fooling our society these days. In just 1 year, we have seen Sam Bankman-Fried of FTX, Ellison of Alameda, and Elizabeth Holmes of Theranos. And now we have another young scammer in town, Charlie Javis. And the target was JPMorganchase. Yes, the largest bank in US with almost $4 trillion in assets, 5,000 branches and 250,000 employees, led by CEO Jamiedimon. Charlie Javis, founder of Frank, an online portal that helps college students to apply for financial aid and get scholarships, sold her company to JPMorganchase in 2021 for $175 million. And now, JPMorganchase have admitted that they got scammed by a fraud business and accused Charlie Javis of a massive fraud and misrepresentation of 4 million students, with 90% of fake accounts. JPMC has filed a lawsuit against Charlie and is trying to get back their entire purchase price. In this video today, we'll talk about Charlie Javis and this $175 million fraud and see how a young founder of a fintech startup scammed one of the largest banks in US. And after a lawsuit by JPMC, why Charlie is suing JP Morgan on the charges of misconduct. And finally, why did JPMC, one of the most trusted banks, rush to buy Frank without doing any due diligence? So if you are interested to know more about this massive fraud by a young fintech founder, then stick around. Charlie Javis, a young entrepreneur from New York, graduated from Wharton School of University of Pennsylvania in 2013. And she started Frank in 2016. Charlie claimed that her inspiration for starting Frank came from her personal experience of piecing together scholarships, aids, and financial support from her family to attend the University of Pennsylvania's Wharton School. Before Frank, Charlie started two other startups. The first one was Power Up, which promoted microfinance and helped students to learn to reduce poverty through business. And the another one was TED, to build an alternative credit score for college students that are just getting started in life. After the failure of both her startups, Charlie didn't want any legally complicated businesses. So this time, the business idea was great to serve the students and to make the complicated process of federal student aid much simpler. If you don't know, the tuition in US universities is very expensive and millions of people rely on grants and loans. The US has a free tool called FAFSA form that determines a student's eligibility for various government student aid schemes. This process is lengthy and complicated and requires students to provide a lot of information and fill many documents. Javis solved this problem by creating a website called frank.org where students can fill their FAFSA forms faster. Frank made the process so efficient that it grew rapidly and also brought popularity for Charlie. Charlie landed a spot on Crane New York's Business 40 under 40 list and Forbes 30 under 30, and also got featured in many articles including Fast Company's Most Creative People list, Yahoo Finance, and Business Insider. Now the important question is, if everything was going so well, then why Charlie sold her company to JPMC? But before answering this question, if you have enjoyed the video so far, please smash on the like button, and if you are interested to know more on the business stories, please subscribe to our channel and click on the bell notification so that you never miss a new video from us. Thank you. By now, Charlie was getting the media attention and was also getting recognized by the big brands. As per Frank's website, by November 2018, it helped 300,000 families unlock over $7 billion in financial aid. A video from Wharton Business School called Charlie the voice of a microfinance generation. But there was a major problem in the Frank's business model. Frank offered FAFSA filing as a free service, so basically they were not generating any real revenue from the business, other than the investment through some seed funding. Another problem with Frank was that it was facing scrutiny from government bodies. The Federal Trade Commission and the Department of Education had allegations on Frank for misleading customers and misrepresenting information. There were allegations of using the personal information of students after misleading them through the false claims and then selling this data to the third-party advertisers. So by now, Charlie knew that no matter how big Frank will become, they won't be able to make money from it. So it was time to sell it to the investor who can eventually get some profit from this business, and the founders can get big checks. Now the most interesting part of this story starts. JPMorganchase found out about Frank and expressed interest. Basically, they were interested in the students and their data to find their prospective customers. If we see from JPMC's point of view, who else can be better than the college students who are just starting their lives and can be part of the JPMC ecosystem? If JPMC can acquire students to open their bank account in Chase, students will of course get Chase debit card, credit card, perhaps some loans in future, and might manage their assets as well. So why not start early? So with this thought, the JPMC team met Charlie and then started the process. As per JPMorganchase, Charlie claimed Frank had 4.25 million users and 50% of them had completed the FAFSA forms. Now, who won't get interested in this lucrative data of prospective customers? So JPMC did the analysis and paid $175 million to buy Frank and offered Charlie the position of managing director and head of student solutions. It was a win-win deal. In fact, the bank planned to pay Charlie a $20 million retention fee if she stuck around with JPMC for a stretch of time after the merger was closed. Now, after the merger, JPMC decided to do a campaign. They randomly picked around 400k users from Frank and sent an email of a financial product. Out of those emails, only 28% emails were delivered and only 1.1% of the delivered emails were opened. While usually JPMC had an email delivery rate of 99% and 30% of the users usually see the emails. Now JPMC got a hint of something suspicious and they started an investigation. As per JPMC, Charlie falsely created users on Frank's website and only had 300k real profiles. As per JPMC claims, Charlie along with Frank's chief growth officer, Olivier Amar, created fake profiles of users on its website with the help of a data science professor from New York. They got the college student data from a company called ASL Marketing Company and paid them over $100k. Then they got student email addresses from another company called Informian for $70,000. And then they created fake emails and addresses using this data. Now the most important question that will come to your mind is, how come a bank like JPMC was not able to get this fraud? Because they must have done some due diligence before buying Frank. Well, here comes the mastermind, Charlie and Amar. When they asked the professor to create fake accounts, they knew generating fake accounts is not difficult. Addresses can be generated randomly with a directory of area codes and the mapping of addresses. And they already bought the emails. The question was that this address should exist because they knew JPMC could easily identify the fake emails and addresses if they saw this data. So instead of mapping these fake addresses and emails to student names directly, they asked the professor to create unique IDs for these attributes and map it to the actual data. When JPMC asked for the sample data, Charlie provided data with unique IDs. When JPMC asked for the actual data for verification, Charlie and Amar very cleverly addressed this by saying that they cannot share the actual data as it would violate the data privacy of its students. So what JPMC saw was some fake names and phone numbers with email and addresses hiding behind the unique IDs. So there was no catch and the deal was done. In fact, Charlie asked the professor to change the invoicing of the payment as well. So in short, Charlie paid around $200k to ASL, Informian and the professor for a list of fake emails and addresses and then sold that list to JPMorganchase for $175 million. Now, JPMorganchase has filed a lawsuit on Charlie and Amar, claiming that they mislead the bank to believe that Frank has 4.25 million customers, whereas they only had 300k customers. In response to JP Morgan's lawsuit, Charlie also filed a countersuit, saying that she was wrongfully terminated from her role in JPMC. She also claimed that the bank did so in order to avoid paying her a $20 million in bonus. Charlie's attorney, Alex Spiro, who earlier represented Elon Musk during the Twitter buyout, said that JP Morgan's lawsuit is a cover-up. After they realized they could not work around existing student privacy laws, they committed misconduct and then tried to retrade the deal. In response, JPMC denied all the claims from Charlie and said that Frank was not as valuable as Charlie claimed and she inflated Frank's value. On January 13th, during JPMC's quarterly earnings call, CEO Jamiedimon called Frank's acquisition a huge mistake. On questions from analysts, Jamie said, "Obviously when you are getting up to bet 300 times a year, you will have errors. And we don't want our company to be terrified of errors and not to do anything." Jamie also said, "Let me tell you the lessons learned when this thing is out of litigation." Well, only time will tell the results of these suits from both the parties. But for now, JPMC has shut down the Frank's website and erased the press release announcing the deal from its own website as well. So that's about this scam today. Let us know what you think about it. Do you think we are creating influencers based on the success stories by media only, or is there any real substance to it? If you have enjoyed this video, please do like it. If you are new here, please subscribe to our channel and help us grow. We are trying to bring more amazing business stories to you. Also, let us know what other business stories you would like to see. With that said, I shall catch you in the next one. Thank you and have a nice day.